Hi, I'm Jimmy. In this video, we're looking at inflation, interest rates, and the federal debt. The goal of this video is to see how each of these can affect the overall economy and ultimately how they could cause a huge problem for the stock market and ultimately our investment portfolios. Okay, so in a recent video I did where we looked at different economic indicators to see how the broader economy is performing, to see if we think that the stock market is going to crash anytime soon, well, broadly speaking, these economic indicators looked fairly good. But when I read through the comments of that video, many people brought up, sure, these look good, but what about inflation? Inflation is a very big deal. So let's start with inflation. Now, we can define inflation in a few different ways. And for us, we're going to use the two primary ways are to look at the money supply, the increase or decrease in money supply, use that as inflation, very valid one. Another one is to use CPI. CPI is short for Consumer Price Index, and this basically looks at the price of goods and services relative to the previous year. So if one number's up 5%, well, that means it's up 5% from the previous year. So we'll come back to the money supply in a second, but for now, we can see that this is a monthly number, and we can see that the most recent months have seen huge jumps in the overall level of inflation. Right now, the most recent level is about 5%. Now, the Federal Reserve has previously stated that they are targeting 2% inflation. But last year, they came out and shifted the wording around that ever so slightly. Basically, what they said is instead of targeting 2% inflation rate, they're going to go after an average of 2% inflation. And that word average changes everything, because they can ultimately let this happen up here at 5% and not really react to it when perhaps it should be reacted to. And here's what I mean. So last year when COVID hit, well, we could see that there was a dip in the overall level of the CPI. And this is very common. Oftentimes in recessionary time periods, well, you see a dip in the price of goods and services. And this makes sense. But now, if they're taking the average, let's say they took the average of since the start of 2020. Well, right now, the average would still be under 2%, even though the current level of inflation is 5%. If we're curious, during this time period, since the start of 2020, we're looking at an average inflation rate of about 1.7%. So that's still behind their 2% target rate. But how far do they let this go? Because this is not, it's sort of like trying to turn an aircraft carrier. They're not going to be able to just turn this around quickly. It's going to take time, and they're going to have to do a lot. The longer they let this go on, the more difficult it's going to be for them to stop it. So when the Federal Reserve steps in and tries to ultimately stop this, well, they've got a couple different tools that they're going to try to use. One is for them to increase interest rates. Higher interest rates should reduce the speed of the economy in general, should lower inflation. Another option is to reduce the money supply. Now, one way we can look at the money supply is to look at the balance sheet of the Federal Reserve. And this balance sheet is important because if they were going to reduce the money supply, well, they could essentially reduce their overall balance sheet. Now, if we're having trouble visualizing how reducing the balance sheet can influence the money supply, well, here's personally how I envision it. Here's how I picture it. So if the Federal Reserve owns a government bond and they decide that they're going to sell that government bond, generally they sell it over to a bank. Well, the bank gives them money. So the bank gives the Federal Reserve money, and that money essentially leaves the economic system. And the same is true vice versa. If they wanted to add money to the system, well, they would buy bonds from banks. They buy the bonds, the cash moves back into the system, and again, more money supply, higher inflation. Now, it's not actually cash that they're moving around. I just want to point that out. But it's essentially the same thing. It's electronic transfer, but it's essentially the same thing as cash. Okay, now back to the Federal Reserve's balance sheet. Well, we can see here that back during the financial crisis, well, they really started pumping money into the broader economy. And frankly, that's nothing compared to what happened over the past year. Now, over the past year, it has more than doubled from about $4 trillion to about $8 trillion, which is crazy. Now, I know what we're thinking. Wait a second. Sure, it's gotten worse. And it looks like not only has it ramped up in the past year, but it was sort of ramping up in the years leading up to that. But surely the economy is larger today than it was many years ago. So comparing today to 1999 doesn't make a lot of sense. And to see how it looks when we compare the size of the balance sheet to GDP, well, we can see right here that it's not quite as bad. It hasn't quite doubled, but overall the chart looks pretty much the same. Right now, the balance sheet represents 35%, about 35% of GDP, which again is insane. Okay, now this brings us to the problem and some potential solutions. So in theory, with rising inflation, well, the Fed, what they could do is they could start to reduce their balance sheet, which would bring this overall amount down, reduce the money supply, and in theory, this leads to the lower price. So lower money supply, lower inflation, lower price for goods and services, and in theory, you can get inflation under control. Now, the problem is, yes, we would get lower inflation, but odds are we would also get lower growth for the broader economy. And the Fed has implied that they would reduce the balance sheet slowly, sort of like they did back in this time period here. We can see that they were gradually reducing it through a few years. And I do think it's important for us to notice that while, yes, this worked, it didn't totally trip up the economy, and they gradually reduced it. That took a few years. At the current level, it will take decades for them to do it. Sure, they could try it a bit faster, but they're more likely to trip up the economy if that's what happened, if they do it faster. So they're going to want to try to avoid that if they can. Because again, what they don't want to do is slow growth too much. Now, another option is for them to increase interest rates. Increasing interest rates puts added downward pressure on inflation. Less people would borrow money, there would be slower circulation of money, and it should lower inflation somewhat. Now, this is a chart of the 10-year Treasury note going back the past few years. And as we can see, historically speaking, interest rates are crazy low right now. Now, we should also point out that the Federal Reserve doesn't actually control the 10-year Treasury rate. This is a freely traded interest rate, sort of freely traded interest rate, but the Federal Reserve has a huge impact on it. Now, as we can imagine, increasing interest rates is not going to be easy for them to do, certainly not today. Now, I've heard rumors that they're talking about doing it in 2023, but again, they're going to have to do it slowly. But if they have to do that slowly to fight inflation, which is rising quickly, well, that becomes a problem. Now, one obvious victim of higher interest rates would be the real estate market. It would also put more pressure on different companies that would need to now borrow money at higher interest rates. Okay, now this brings us back to the question, how do we position our investment portfolios for this ultimate reality that we find ourselves in today? Well, I think a smart move is for us to hedge our investment portfolios against inflation. How much do we want to hedge, or how important is it for us to hedge? Well, that depends on a lot of our own personal situations. How much risk tolerance do we have? How long are we investing for? What's our the current makeup of our portfolio? Now, overall, I do think that we can do a few simple things to protect ourselves against higher inflation if we find it necessary. We could buy something super simple like a Treasury Inflation Protected Security, or TIPS for short. And I did a video on that if you're curious. I'll leave a link to that video in the description below. But basically, as inflation rises, it's sort of like a bond that as inflation rises, but you make more money the higher inflation goes. So it could be a way to do it. It could be a way to hedge yourself. We could also add some international investments. If, for me, my personal portfolio is primarily US investments. Well, if we have primarily US, we could go overseas where perhaps their inflationary pressures aren't as big, so that could help diversify things a bit as well. We could also go with commodities. Commodities have historically done quite well in higher inflationary environments. So I think buying something like gold or silver, or both, could make a lot of sense. Now, if I were hedging my personal investment portfolio, what I would be probably doing is I'd probably add gold and then an ETF that covers a basket of other commodities. Because again, a lot of commodities do very well in higher inflationary environments. So I would do a basket and gold, two different positions, maybe 5% of the portfolio, 5% of the portfolio. That way you get a 10% hedge for your overall portfolio. Besides that, I think it makes sense to continue to look for good value stocks and try to identify sectors that could do fairly well. We actually talked about some of these sectors in the last video where we looked at different economic indicators to see how the broader economy is doing. So if you're curious, perhaps that's a good next video for you to watch. I get a link right here. I've got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.